So welcome to the 67th meeting of the French Economic Association, AFSE. On behalf of AFSE and Paris School of Economics, welcome here. I'm Agnès Bénassy-Quéré, the current president of the association and also the president of the local organization committee. So before introducing our keynote speaker, Jean Tirole, we have a welcome address by our director, Pierre-Yves Joffard, and then I will give a few housekeeping information.
Thank you, Agnès. So I will be very, very short. I just want to say you... c'est en anglais ou en français, en fait? In English. In English. Okay, sorry. It's... so welcome to all of you at PSE. We're very, very happy to host this Congress. It's one of the first big events that we organize at PSE. So it's you're coming in a brand new building, not only in this great room, but you will see other rooms. It's for PSE. It's a major change. It's been a long-term project. The whole thing was designed about 10 years ago. This is very long decision processes. When we designed the process, I would lie if I said that we had in mind that this building should be able to host the AFSE Congress. But nevertheless, we're very happy that we can do it. We've already hosted many workshops, conferences, seminars. There's about 10 seminars every week going on, recurrent seminars at PSE. We host 120 researchers, permanent researchers, plus almost 180 PhD students. So this is a very active and very lively place with lots of debates. We also tend to promote a vision of economics which is open to other disciplines, to history, of course, but also demography, sociology, and we try to make this happen in this building. So again, we're very happy. And this vision of economics, I think, is completely shared with AFSE, I hope. So when I look at the program, at least that's what seems to me very clear in the orientation. So again, I hope that you will enjoy these days. I hope that you will like this this place. Sorry for the weather, but this is beyond our control. But that means that we are not going to be able to enjoy the garden, which is too bad. But bring an umbrella and have fun for the next 3 days. Bye bye.
So now I'm not going to introduce in length Jean Tirole. Probably you already have heard about him. So he's a professor in economics, well known for his research on industrial organization, regulation, and finance, but also macroeconomics and even psychology. He received the Nobel Prize, or rather he's a laureate of the Sverige Riksbank Prize in Economic Science in memory of Alfred Nobel in 2014, and also laureate of the CNRS Gold Medal in 2007. He's the chairman of the Jean-Jacques Lafont Toulouse School of Economic Foundation and scientific director of the Institute for Industrial Economics. Also a visiting professor at MIT, so we are lucky that he's not at MIT today. An author of a recent book that has been translated in many languages, Economics of the Common Good, Princeton University Press, accessible for a wide audience. He's a member of the French Council of Economic Analysis, and which advises the Prime Minister. He's an extremely nice person, as you will, and very modest, as you see. So thanks so much for accepting our invitation. I think you are going to talk about new threats on financial stability and the future of financial regulation. Thank you so much.
Well, thank you, Agnès, for those kind words. You made me blush. Well, she's gone. Thanks so much. Thank you for organizing this wonderful Congress, and thanks to PSE for its hospitality, this wonderful amphitheater and building. I'm going to discuss threats on the financial system, which are still around. I must say I'm still worried about the financial system, despite progress which has been made. If you look at if you look at what has happened since 2008, there's been a progress in regulation with more capital requested from banks, higher capital requirements, counter-cyclical capital requirements, liquidity ratios, less reliance on OTC market, better infrastructure, in particular with the first leg of the banking union. So all of that is very positive, I would say. Now, if you look at the detail, it's a little bit more complicated because the implementation, there's a big difference between the formal rules, which I think have improved, and the actual regulation or supervision, which is different, and it's in general lighter, and there are threats all over the place. And I'm going to talk about two such threats or unsolved issues. The first will be the one on shadow banking, which is a current concern. This will be joint work with Emmanuel Fari. And the other one is on the monitoring of liquidity. As you may know, Basel III has introduced a new liquidity ratio. It didn't exist before, without any guidance, almost any guidance from economists. And that's a bit of a concern, of course. And if we have time at the end, we'll wonder whether what has been done has actually made sense. And actually that's a lesson for economists, is that we should actually anticipate issues, not react to issues. I mean, this is really very much of a reaction to issues, to an issue. I mean, it's not over because there is still a lot of, the liquidity ratios are here to stay, but, I think we should anticipate more. Mea culpa, just like everybody else. So let me start with shadow banking. When I grew, I was the age of most of you in the room. When I grew up, I basically learned there were two kinds of banks. The first is the retail banks, or insurance companies, or pension funds, all kinds of institutions which were prudentially regulated, so as to make sure they had enough capital. And those institutions had access to public liquidity in two forms. The first is deposit insurance. The second form is lender of last resort. And then there was another group of banks called shadow banks, which it's not totally clear what they are. I mean, they can be hedge funds, money market mutual funds, investment banks, and so on, special purpose vehicles, whatever. But the key thing is that they are not regulated or very lightly regulated, and they don't have access to public liquidity. So the world was simple. The world was very simple, except that we have seen in 2008 that shadow banks actually may gain access to public liquidity, either indirectly through siphoning. So that's what I call the Conduit syndrome. So all the retail banks were basically issuing lines of credit to conduits, which are unregulated shadow banks. And of course, those shadow banks enjoy those lines of credit. So basically, public liquidity went to the retail banks and then on to the shadow banks. The second aspect is what I call the AIG syndrome, which is that even if you are a shadow bank, you could have access to bailouts. And it's not only AIG, of course, it's many other shadow banks. And there have been various non-conventional policies which have been used in case of stress, which basically rescued the shadow banks. So this whole theory according to which only the retail banks have access to public liquidity and public money, in a sense, is wrong. I mean, everything I learned when I was young is wrong, unfortunately. So I would like to understand now. There are, of course, big statements by regulators saying, no more of that. Okay, but the question is, why and how? So there have been a number of migration waves too. So that's another thing that you want to take into account, is that if you try to regulate retail banks more strictly, which we have tried to do, at least on paper, as I mentioned, since 2008. I'm in trouble. I need a bailout. Okay. Okay, I'm going to continue, and then my presentation may be shorter than planned. So anyway, anytime you try to regulate more strictly the banks or retail banks, of course there will be a tendency to migrate to unregulated banks, and that's what you have seen before 2008, even so there was not much regulation of retail banks. But you see a lot since 2008. So you see it in China, you see it in Europe, you see it in the US. There is more and more migration of activities, dangerous activities, toward the shadow banking sector. And sometimes, actually, the government does help, actually. This is a strange thing. So, for example, in the US, the subprime loans now have migrated to the shadow banking sector. They used to be 20% in the shadow banking sector. Now they're 75% in the shadow banking sector. And what happens is that the government actually helps those shadow banks securitize. Actually, most of the subprime loans are sold to the government, which is just totally amazing. Basically, the government is subsidizing the shadow banks. And if you think about it, it's kind of strange. Okay, so the migration waves are very important. So what motivated us to do this research was a quadrilogy. So again, I come back to what I learned when I was a student, basically that a retail bank is characterized by 4 characteristics. The first is prudential supervision. The second is access to public liquidity. And the third and the fourth have to do with fragile or politically sensitive clients. They may be on the asset side of the balance sheet, the small and medium enterprises. In general, they are very fragile entities, and they also have political support. And on the liability side of the balance sheet, there will be the deposits, you and I. Okay. Now, the thing is that you have to ask yourself, and I should have asked myself when I was a student, actually, why is that? Is there any reason for that? And it's not an obvious proposition in a sense. Take access to public liquidity, deposit insurance, which allows you to roll over deposits when you're in trouble, and lend of last resort. Okay? After all, those are services provided by the government, and you could very well actually offer that to the shadow banking sector against a price. You can always charge for this service, and it could be profitable for the government actually to charge for those services. The other thing is, of course, that small and medium enterprise can actually borrow from shadow banks. They do now. Depositors actually can migrate to shadow banks. That's what they do in China, and partly because of the inefficiency of state-owned banks, but and political objective imposed upon them. Okay. In the end, you are okay. Sorry. I'm going to transform later on a quadrilogy into an hexalogy, and I'm going to take into account and try to find the rationale for 2 other things which have happened: the structural reforms. You all know the Volcker rule or the Vickers rule or the Liikanen rule and their various features. But basically, in a nutshell, basically try to separate retail banking from shadow banking. Okay, make sure that shadow bank difficulties don't translate into retail bank difficulties. The other big move which I've approved substantially is there's been a move away from over the trading OTC markets toward the CCP, so Center Clearing Counterparties, so as to better monitor the banks. One of the big issues with OTC market is that the regulator, it's a question of asymmetric information fundamentally. Those are very bespoke products. And then, so it's been bailed out now, I can continue. But the thing is that it's very hard for the regulators to actually know what the exposures are on OTC market. And CCPs actually reduce the asymmetric information. Okay, so in this paper with Emmanuel Fary, we basically built on the 4 hazards facing financial system. The first is well known, of course, is risk-taking incentives. Second is that you can have a bailout. I'm moving to the fourth, actually. You can have a bailout of either the banks themselves or you can have a bailout of the small investors in the bank. And actually in the model we'll get both. You can have a migration in reaction to stricter prudential control, and you can have cross-exposure between regulated and shadow banks. Okay? Now, let me just make a distinction between two things. A bailout and lender of last resort. A bailout is a spontaneous thing, so you don't contract for it. You know, Crédit Lyonnais goes bankrupt, you bring money. You haven't contracted for it. You don't have to necessarily. Also, Crédit Lyonnais was a retail bank, but let's take rather, you know, ARG or all the big 5 investment banks in 2008. There was no obligation, no legal obligation to come to their rescue, and except for Lehman, the U.S. government came to their rescue, and that's a bailout. It's not contracted for. Think of lender of last resort as some normal thing that, in principle, you will come to the rescue of the bank, as long as the bank ex ante accepts a number of conditions. Okay. A word on the public supply of liquidity. You know that one of the main things in macroeconomics, of course, counter-cyclical policies. And in the case of banking, they include open market operations, discount window, bailouts, guarantees, automatic stabilizers, and so on. And the one thing, you know, if you are a Chicago economist, I'm not a Chicago economist, but if you're a Chicago economist, you have to ask a question, which is important, of course, is what is it that the government can do that the private sector cannot do? And that was central to my work with Bank Tomstrom in the 90s and then with Emmanuel Faye. And we came up with the following reason. You have to explain, if you want to have a normative model, if you want to do policy, you really have to explain why it is the case that the private sector cannot do it in terms of liquidity provision. So our explanation, and it's just an assumption to be honest, is that the government has a specific monopoly. It's a regalian taxation power, which recreates missing markets between consumers. They cannot pledge their future endowment, and therefore they cannot give, in a sense, lines of credit to banks and firms. The other thing that comes out of this kind of analysis is that state contingent liquidity provision is actually the most efficient. The private sector can create some of its own liquidity so as to cover its own shocks, but in extreme circumstances, that's not efficient because, you know, if you have a probability 1% of a big liquidity shock accruing in the economy, then it's more efficient to have the government provide the liquidity. Okay, and that's what the kind of analysis, theoretical analysis gives you. Okay, before you fall asleep, let me mention the take-home points. So we write a very abstract model in which banks may be liquid and receive support from the state. So there's a possibility of bailouts. There's a possibility also of lender of last resort. And we obtain the quadrilogy. And the basic argument that there are complementarities between regulation and the 3 other components of the quadrilogy. Regulation is about limiting risk-taking. And by limiting risk-taking, it is particularly valuable if the banks lend to SMEs. Because if a bank lends to SMEs, you have a put on taxpayer money. And that's a very fundamental thing, is that the government doesn't want to let banks fail because it's very worried about the economic activity. Okay, even if it's not captured by the bankers, it's still the case that the government actually may want to bail out the bank simply because it doesn't want to stop the flow of credit. So this put on taxpayer money is costly for the state, and because it's costly for the state, you want to reduce it. And there is this natural complementarity between regulation, which is reduce risk-taking, and lending to SMEs. And similarly, on the other side of the balance sheet, there's a complementarity between regulation and deposit insurance. Again, deposit insurance is a form of insurance. It's costly for the state, and you want to reduce the occurrence of it happening. And therefore, you want to regulate. Okay? We transform that into an exology, as I said, is that later on we provide a justification for structural method like ringfencing and for the use of clearing houses as opposed to OTC markets. Okay, and we capture the possibility of exploitation of public liquidity by shadow banks that I was mentioning earlier, and I will come back to that in a minute. So let me just give you the structure of the model. It's a standard model of liquidity provision, so you need at least 3 periods, of course, because you need an intermediate state in which banks have trouble refinancing. So at date 0, basically the bank invests. There is some kind of investment cost. And at that point of time, they may engage in moral hazard, so they may increase their risk. In that case, the increase in risk will be about increasing the probability of liquidity shock at date 1. Now, what monitoring is going to do, and there will be costly monitoring, is basically reduce the probability of reduce moral hazard, so make it more difficult for the bank to increase its risk. That's the way we formalize it. Then at date 1, there is a liquidity shock. And if you want to continue, you really have to meet this liquidity shock. So if you need more cash in order to continue your investment, and you may either stop or continue. Maybe you can do something in between, only continue some of your investment. But in any case, you need cash in order to face this liquidity shock. And if you continue, then the bankers have some payoff, and the investor receives some pledgeable income. So if for those of you who are familiar with this kind of model, the important thing to explain why you may face a liquidity crisis at date 1 is that you are not in a Rodebrød world. What happens is that there is some of the money which is not pledgeable to investors. If everything is pledgeable to investors, we know since Kenaro that you can finance as you go. So you can always find financing at date 1, and there is never any liquidity shock, and therefore never any macroeconomic policies, at least the macroeconomic policies that I mentioned. So it must be the case somehow that there are some benefits which cannot be pledged to investors, or at least to small investors like depositors. And the investors receive pledgeable income. Yeah, that is, I apologize for the old notation from my work with Bengt Holmström. We call that rho 0. But the important thing is that this pledgeable income is smaller than the liquidity shock. So a liquidity shock will be 1, for example, and then you don't need you cannot just dilute existing claim holders in order to refinance and continue. And those are very typical. Any model of liquidity has this kind of feature. So it's very stylized, but you need this kind of assumption if you want to justify why you have liquidity crisis. I forgot. Okay, now, standard thing in all those models is how you meet the liquidity shock. And you have 3 ways. It's very important. You always have 3 ways of doing it. The first way is just to buy self-insurance. So you store at date 0 some safe stores of value, treasury bonds or the like. Actually, in the work with Matthias de Watripon, we will have a more general view of that. But you hold some stores of value that you can resell. Maybe also some legacy assets you can securitize. And the limit, of course, is that there is a limited supply of that. Okay, in the model, we assume no store of value, other store of value, but you can, as long as it's scarce, that's fine. Okay. Second aspect is that you can go, that's on the asset side of the balance sheet. On the liability side of the balance sheet, you can basically bail-in securities. And actually, that's one of the big things nowadays in regulation is this push toward bailing in securities. Traditionally, we have bail-in only equity, right? Only equity was bail-inable, meaning that you can erase it and expropriate it if there's trouble. Now, the push of the regulator is to move toward other kinds of securities which can be bail-in. Preferred equity, COCOs, subordinate debt, and so on. The maximum, theoretical maximum, and in general it will be smaller, is basically the pledgeable income. I mean, rho 0, what I call rho 0. If you have risk-averse depositors, it's smaller. So if you have risk-averse investors, then actually you don't want to dilute everything, and therefore it's going to be even smaller. And the third source of liquidity we have seen, of course, is government support. So a bailout, so again, my definition of a bailout is spontaneous, or lender of last resort, which is a dead zero promise, or implicit promise. And the limit to that is, of course, a random cost. Think of the random cost as being a fiscal cost, a shadow cost of public funds, which might be random, or it could be a political cost. I don't care. It could be a political cost for the government actually to bail out the banks, either way. So those three elements will be there in the model. And they are the standard three elements, three ways in which you can meet liquidity shocks. Okay? And again, you know, what distinguishes this economy from our other economy is that, you know, there's a limited supply of safe stores of value. You can bail in securities, but there is a limit to that. And there are something the investors cannot put their hands on. And finally, that justifies government support. So the stochastic structure is a little bit complicated. Not that much, don't worry. I mean, so think about there are two liquidity shocks in this economy. There is a shock to public finances, which is going to basically introduce some uncertainty about whether you're going to be bailed out or not. And there is a liquidity shock for the banks. So let me start with the former. In the good state of nature, stage E, there will be a cost of raising funds, small lambda greater than 1. And it's going to be small enough that there will be a bailout. There will be a bailout even for shadow banks, right? Even if you're in a shadow banking sector, there will be a bailout, exactly as happened in 2008. Is the fiscal cost lambda, capital lambda in the bad state of nature, state B, then the shock, there won't be a spontaneous bailout because the shock for the government is too big and the government may not want to bail out. Again, it could be a shock to public finances or it could be a political cost. Either way, I just want some uncertainty about whether the banks will be bailed out. And then there is a liquidity shock. So there is priority P of a bad state, 1 minus P of a good state, and then the liquidity shock incurred by the bank. So with priority pi h, there is no liquidity shock, so you can go to day 2 without having to put in some more cash. With priority pi l, you basically need more cash. You need 1 per unit of investment to reinvest, or it could be a continuous variable or whatever. And the way we formalize moral hazard is just by saying, if I engage in moral hazard, so I increase the risk of a liquidity shock. So instead of being pi L, it becomes pi plus delta in the good state and pi L plus delta prime in the bad state of nature. So basically, risk-taking amounts to increasing the probability of liquidity shock. It's two-dimensional, so I can choose, it doesn't matter, but I can choose to shirk for the good state and shirk for the bad state by just changing my portfolio, basically, so that I take more risk in the good state or the bad state. Okay. Importantly, I assume for the moment, that conditional on effort, liquidity shocks are perfectly correlated among banks. What does it mean? If you have perfect correlation among banks, that simply means that there is no scope for cross-exposure. So all the kind of things we talk about, domino effects and the like, cannot occur in this economy, at least, because in principle, you should prohibit any cross-exposure because the shocks are perfectly correlated. Therefore, there is no insurance motive across banks. Okay, that's what this assumption does. The monitoring, so if you are a regulated bank, so regulation in this model will be very simple. I basically prevent moral hazard. More generally, I reduce moral hazard. So I can prevent moral hazard. So if you're a bank and you have a contract with me, the regulator, I basically reduce your moral hazard. I eliminate it, actually. And there is a cost of doing that. Now, in terms of the social planner will care about consumers and investors, will care about small and medium enterprises or economic activity more generally. And it's not a capture story. Actually, in this model, the regulator is not going to bail out the bank because it's captured by banks, but simply because he wants the economic activity to go on. or it wants to protect possibly the small depositors. So I'll make this assumption, which basically is an assumption that gives you some randomness about bailouts. So basically, if there's a liquidity shock for the bank, then the banks need one unit there. And they have only row 0, which is by diluting their existing claim holders, they can get basically the pledgeable income. So the shortfall is 1 minus row 0. And this condition here says that the weight you put on completion is sufficiently small, is sufficiently large to justify a bailout in the bad state of nature, in the good state of nature, and sufficiently, and when it's a bad state of nature, then you don't want to bail out the banks. Okay? What is beta? Beta is the weight you put on the activity continuing. Okay? It's a very standard parameter. It has micro foundations. It's a very standard thing. Basically, what you want to do as a regulator is to rescue the small and medium enterprises. You want their workers to keep getting their wage and so on. So that's the story behind the micro foundations. Okay, but beyond this condition, basically, we have the condition that you don't know in advance whether you'll be bailed out or not. Okay, because otherwise there would be no lender of last resort. If you know that you're always bailed out, then there is no way you can be pushed to purchase a lender of last resort insurance. Okay, that's what we need. So, sorry, I'm going a little bit fast with this model, but just to give you the structure, which is a very, very standard structure in the literature on liquidity shortages. So the first insight, as I mentioned, is a complementarity between regulation and lender of last resort. And again, this is a very straightforward thing, is that liquidity provision, in that case, it's the bad fiscal state, because in the good fiscal state, you'll be bailed out anyway. So you don't need any more insurance. It's only in the bad fiscal state that you can buy lender of last resort. And the liquidity provision creates insurance. Insurance creates more hazard, and therefore that's why you want to regulate. Okay, so there's a complementary, basic complementarity between insurance, regulation, and regulation and lender of last resort. Same thing with deposit insurance. So far, imagine you can dilute, we have imagined that you can dilute the entire, if there is trouble, you can always expropriate the investors and bail them in. Now, in practice, that's not the case. We introduced two kinds of depositors. One is ordinary depositors, who are kind of risk-neutral parties, and they just care about their expected return, and therefore they don't mind, in quote, being bailed in. And special depositors who are risk-averse. And one very simple way, and that's a good trick for those of you who are doing theory in the field, is you just assume that they have this kind of project. It's kind of diamond debuggy in a sense. You have this kind of project, and you need the money to, if you go unemployed, if you want to buy a house, if you want to send your children to college, and with one euro, that has value to you 1 plus theta euros. So here's a UTIF function. Actually, this inequality should be reversed, but doesn't matter. But you have a demand, basically, for insurance. And then, basically, let me say a few words about this, because this is very interesting, and there's a huge research program there, which we haven't completed. We haven't done, actually. We've only touched on it, which is, you may not, if you have risk-averse depositors like you and me, at least on part of our wealth, right? We may not be risk-averse on the entire wealth. Then there is a motive for insurance. And therefore, you can price deposit insurance, which, by the way, is not quite done in many European countries, but that's another thing. You can price it and charge the banks for it. The problem with that is if depositors migrate to the shadow banking sector, then they may count on some implicit deposit insurance. And something we have discovered, which hasn't, to our knowledge, been dealt with, but it's fascinating, is that some assets, like some liabilities of banks, or more generally assets, can have state contingent valuations. Okay, and so they are completely endogenous, I'm sorry, clientele contingent. I'm state dependent, it's not new. But clientele contingent valuations. And let me just tell you why. It's very simple. Imagine that all of us in this room put our savings in a shadow bank, and we are small depositors. Then chances are that the government will rescue us, okay? And that happens. When money market mutual fund breaks a buck, the government steps in and basically bails out the money market mutual funds by giving lines of credit, right? So if we all move to the unregulated sector, then there will be a bailout. At the same time, so that means the shadow banking sector will be very attractive. If none of us move to the shadow banking sector, that's not going to happen because those claims will be held by risk-neutral depositor investors, and therefore they will not be bailed out. So basically, the value of an asset will be contingent on what the clientele is. And you can imagine right away there can be multiple equibia. Okay? So the question is, what is the optimal public policy in that case? And the optimal public policy we show is actually to offer deposit insurance only to the regulated sector. And that solves the conundrum I was mentioning earlier, which is that why don't you offer deposit insurance within the shadow banking sector? Because you can always price it, okay? And the answer is you try to keep the savings of small depositors in the retail banking sector, and that's the efficient thing to do, okay? But of course, there will always be a tendency to move and migrate to the shadow banking sector, and that's really the issue. Okay, so what we show is also, even if you have small depositors and you cannot pledge the entire pledgeable income, you also want to have deposit insurance limited to the retail sector. Even so, you could price it to the shadow banking sector. I don't know, Agnès, how long? 10. She said 15, I reduced it to 10. Okay. Then I told you that, and I'm going very fast, so it's really an advertisement for the paper. It's on our website if you want to look at it. Then we tried to study two things which I've not been studying, ring fencing, but have been happening in the regulatory sphere, ring fencing and CCPs. Ring fencing is about exposures between the retail banking sector and the shadow banking sector. So far, as I said, the fact we assume correlated shocks means there was no scope for liquidity pooling. There was no cross-insurance between banks. If they face the same shock, you just should prohibit any kind of cross-exposure. Now, if they don't face the same shock, that's different because you may want them to cross-insure. The problem is, again, a problem of information. Okay? Are they going to re-cross-insure, or are they going to maximize their put on taxpayer money? Now, guess what the incentive is? The incentive is to maximize the put on taxpayer money, right? And you really want to, that's really the thing. And what we show is that actually, if you don't pay attention to it, it's going to be abused. There can be a bogus liquidity. So, for example, and that was the case in ARG, banks and insurance companies, including some French ones, by the way, actually got insurance from ARG through CDSs, right? But that was fake insurance. It was bogus insurance. Because if ARG, of course, goes under, you don't get the insurance anymore. And thanks God, AIG was rescued by the US government. That was great, right, for us. But in the end, the thing is that you need to make sure that actually the insurance, I mean, it's an old problem, the insuring company is actually going to be solvent whenever you need the money. And one of the things is that the shadow banks are not prudentially overseen, and you don't know whether your retail banks will get the insurance from the shadow banks when there are liquidity shocks. Okay, so that's an issue. So what we do is to create scope for cross exposures. And so we have this model where you can have cross exposures and therefore some legitimate insurance motive, positions across banks. But in the end, if you don't monitor the balance sheet of the shadow banks, you never know whether your retail banks actually get insurance or not. Now, and in a nutshell, the problem may arise even within the retail banking sector. So if you have two retail banks that you supervise, but you are unable to check that they're actually supplying themselves insurance as opposed to increasing the put on taxpayer money, then you'll be in trouble. And we show there that CCPs can help, because CCPs prevent risk selection. So I cannot just go to Agnès knowing that her positions are correlated with mine, perfectly correlated with mine. So actually there is no real insurance which is provided. That's not doable on a CCP. On an OTC market, I can do that every day. An OTC market, I choose Agnès. I know she's perfectly correlated with me. And I maximize my put on taxpayer money. So that theory gives you both motivation for ring fencing between shadow banks and retail banks, and also some scope for CCP. So I'm going a little bit fast because I want to say a few words, and we'll keep a few minutes for discussion. Okay. That's called a soft budget constraint. So the second project that I want, which is not, it will be on our website in a month or two. It's almost done, but is a project with Mathias de Watripon on another aspects of Basel III. There's been much regulatory activity on the liquidity front since 2008. So as you know, there's been an introduction of a liquidity coverage ratio with a short horizon, 1 month, and a net stable funding ratio with a longer horizon. That's one aspect. And now there is a push toward making the set of bail-enabled securities larger. So again, don't go just after equity, but also dilute. If there's any issue, you can dilute junior claims as well. All of this is happening, and I'll come back to my first remark, without any guidance from academia. And I feel very ashamed about this, and I think we need to improve our our operations. And the kind of questions we have, and I must disclose that Mathias, until very recently, was a central banker and actually went often to Frankfurt and Basel. So there's a little disclosure there. But what we tried to do, but he's now back at Université Libre de Bruxelles. What I want to study is on the liability side, which liabilities should be built in. Should it stop at COCOs? Should it go to junior debt, subordinate debt? Do you have any answer to that? There's been a push to broadening, as I'm mentioning. Should it depend on which country you're in? So I told you about 3 ways of meeting liquidity shocks, one of them being owning liquid assets, right? Now, liquid assets usually are treasury bonds or the like. So if you are in Australia, you have 20% of GDP in treasury bonds. If you are in Japan, 250. Is that the same? And you have much, unless you are diversified globally, that's not the same. And then the pecking order, how do you dilute them? And on the asset side, okay, that was the bonds were on the asset side. Do you want to have a single measure, or do you want to have multiple tiers, the way it's done for capital, for example? Now, in Basel III, it's called level 1, level 2 levels. No, there's only 2. Level 1, level 2A, level 2B, kind of liquidity. So technically, you can think about liquidity-weighted assets. So do you want to dictate some kind of minimum liquidity? So think about liquid assets I. Then you can have a discount, and that's what's being done in practice. You can have a discount. So you take into account the discount, the liquidity discount, if you resell the asset. So you may not sell at full value. You may apply a liquidity discount. So you have treasury bonds, they will sell very well. If you have some other less liquid asset, they will sell less well. And then you could also add to that the billable securities on the liability side, which are indexed by J. Okay? Or do you want to append some minimum level I liquidity asset requirements? So in practice, under Basel III, you put some minimum amount of level 1 liquidity. So the highly liquid assets, the more liquid assets, actually, there's a minimum amount of that. Okay. Big question is, should central bank eligible assets be counted as high quality liquid assets? The answer, which was given after a long debate, is no. So those which are accepted at the ECB, for example, do they count as being highly liquid asset? The answer is no, but there was no analysis of what happens. There was a lot of pressure to put them in, as you might imagine. And basically the picture we get from the theoretical model, which basically is a little bit like is actually a bit simpler than the model with Emmanuel, but uses some of the ingredients, is basically the following. For those of you, by the way, who know electricity markets, there are a number of analogies which are absolutely fascinating. But on the asset side, you have a pecking order. So you are going first to resell level 1 liquid assets and then level 2 liquid assets, or maybe you could have more levels if you want. And possibly you can securitize some illiquid assets. And on the liability side, you do the same thing. So you first dilute equity and then all kinds of junior debt and so on. Okay, and some of these are not liquid. So here are the insights, and again, it goes too fast. It's just an advertisement. We find a pecking order on both sides of the market. So, for example, on the asset side, you start with baseline liquidity, which is used most of the time. Your treasury bonds, you resell them easily. There is a very low discount when you resell them. Then you use peak load liquidity. Okay. Now, do you want to use a simple liquidity weighted asset requirement, just the way it was written here? Or do you want to have some minimum level 1 liquidity? And the answer is depends on whether there are fire sales or not. So fire sales is basically when the demand for the asset is downward sloping and it's not perfectly. It's different from liquidity discounts, by the way. It's very different. But you know, if you have negative shocks on the demand side, if you have no negative shock on the demand side, a simple liquidity requirements like this works. Otherwise, you need a minimum level of level 1 liquidity. Forget about this graph, but basically, liquidity requirements increase with supply availability. What does it mean? That means that if you're in Japan, there's no problem about getting treasury bonds. There's plenty of them, so you ask for a lot of level 1 liquidity. If you're in Australia, that's different. There are only 20% liquidity, and all the banks and insurance companies and pension funds want to have access to that. So you need to ask for less level 1 liquidity and substitute for things like central bank liquidity lines. Okay. And on the liability side, you do the same. So there what we do is basically to assume that people have different risk aversion. So it's exactly the same trick that I was using earlier. So there is a fixed amount of deposits for which there's a multiplier. Sorry, it's a bit different notation, but there's a multiplier, and so you're more or less risk averse. And you know, when you bail in, you start with those who are most risk neutral, like equity holders, and then you move up the balance sheet. There's no rationing for initial deposit. You can decentralize possibly through liquidity weighted asset requirement, and you adapt to local conditions as well. So if you compare that, and that will be my last word, and I apologize for going so fast. If you compare to the one which is in place right now, which is a liquidity coverage ratio, if you look at the formula, it basically says a stock of high-quality liquid asset that you have available has to exceed the total net cash outflows over the next 30 days. So what we do is we look at the prediction of the theory model, the simple theory model, and compare that to what has been done. Okay. Now, what they call high-quality liquidity assets is, of course, they should not be used as collateral for somebody else. They should be available and unencumbered. They may not be, they are a priori central bank eligible asset, but what we show is that central bank eligibility should not guarantee that you are a high-quality liquid asset. So in that sense, we support the point of view of those who actually argue for the current regulation, and against those who actually wanted the central bank eligible assets to be part of the high-quality liquid asset. And the logic for that is actually simple, which is that if you think about central bank eligible assets, that's reacting to macro shock. It's a macroeconomic issue, right? The high-quality liquid asset is self-insured by the bank. So it's a difference between a micro and macro in a sense, and they don't have to be the same. So, you know, if there's a big macro shock, you may want the central bank actually to enlarge a set of central bank eligible assets. But ex ante, you may want, you know, to have a smaller set of high-quality liquid assets, and that's the logic of the result. So on the asset side, actually, we find very much exactly the same formula which has been used, you know, without any guidance for academia. So it's a little bit reassuring. Of course, you know, there are some economists who have been involved, fortunately, in the process, so their intuition was not bad. On the liability side, we find a big difference. On the liability side, and let me explain what the difference is, because that's where we fundamentally disagree with what has been done. On the liability side, we found that you should treat retail deposit and wholesale deposit the same. Why? Well, simply because if you go back to this, retail deposits, your deposits, are actually insured. Wholesale deposits are not, but they are de facto insured because they can run, right? So they are usually overnight deposits, and you know they can run very fast. If there's any trouble with the bank, they can go away. So de facto they are insured. So they should be treated the same. Whereas under current regulation, basically you have to cover again an outflow of the wholesale deposit, 100%. So you imagine that all wholesale deposits go away. And retail deposits, of course, they stay in. But that's a wrong narrative. It's correct, but it's misleading, which is, it's true that the wholesale deposits, they can run away very fast. The retail deposits don't run away because they are insured, so they are very stable. That's correct. But the problem with that is, de facto, they are both insured. And that means they should be treated the same. And that's a big difference we have with what has been done. So to repeat, on the asset side of the balance sheet, we pretty much agree with what has been done. On the liability side, we disagree. We also find, as I mentioned, that you should have a different treatment for Australia and Japan. Very much a way it has been done. Okay? So, well, thank you for your attention. That was my last slide.